Hey everybody, happy Thursday, June 25th. It's about 12:30 in the afternoon on the West Coast and it's time for another market update. Well, as I'm sure you guys have seen, so far the war and or the peace with deal that we have going through Iran is holding for now. There's been some minor aggressions, I think, but nothing major. It seems like things are at least going positively for now. Obviously, I can get off this video and check my phone, and something could have happened. So don't hold that against me. That's why I always tell you guys the time and date, so I can say, "Hey, see, that's what was going on when I did it." But also, we know that oil prices are coming down, so more oil is flowing freely through the strait. So on an economic level, that's great, and we'll get into that here in a second. But for now, at least, the peace agreement that they've come to, I think, to negotiate a longer peace deal and set up is holding, and let's just hope that continues for both, like I said, economic reasons and more importantly, moral reasons. Next thing we got. So we got May PCE. PCE is the Fed's favorite form of inflation historically. This might change with the new Fed chair to look at and to look how the economy is doing. And so let's take a look at this real quick. But again, it was for the month of May, and this came in really high. I think it's in the highest levels in a couple of years or so forth. You can see the headlines up to 4.1%, the core's up to 3.4%, and we know the Fed's target is 2% on that core number. And again, that headline number is the highest it says right there is the highest annual level in 3 years. However, the markets are kind of looking past this because what we just, one reason what we just talked about on that headline number, these are numbers for May, and that was, the war with Iran was still going on. There wasn't this peace agreement in place. Since that's happened, and now we're into the month of June, we know that there's more oil flowing freely. I think oil's down $30 a barrel compared to about this point last month. So the markets are saying, hey, this high headline number really doesn't matter because it's old data, and we know that things have changed now, which is a great way for the markets to look at it. Let's hope the Fed looks at things like a little bit more forward thinking like that. So again, headline number is elevated and really high, but we know that a lot of that, if you look at that chart, you can see it started in February, and that's when that war with Iran started. So that will take care of that number. Hopefully, there will be some fallout. There will be some time needed for inflation to come down and for the economy to recover. There will be some negative effects of the slowdown and the oil coming through, because that created like a slowdown in gas production and so forth. The second part of this is the core number. So the core number was at 3.4%. One thing that's adding into this core number that isn't really economic related or something the Fed should try to control is portfolio management. So, a lot more trading going on. People were making more money, and a lot of these, the people on the stock side and portfolio management and stuff, they make money off how much money you're making on your stuff. So, if stocks are going great, then they're going to make more money. So that was creating more inflation. So their fees went up, creating inflation on that side because people were making more money off their portfolios. With the last few days, and if that's kind of reversing course a little bit, we should expect that to drop off as well because they'll be making less money. So again, important report in general. Maybe not. It's going to be going forward. And then again, this one, since it was the world's changed so much since basically this data was collected, the markets are kind of overlooking it. Next thing we got was May new home sales. So these are again new construction that were finished or went pending in the month of May. And that was down 7.3% month over month, and they're now down 6.8% year over year, which is not good. I think you see signed contracts were about 580,000, and that was I think expected to be around 640. So quite a big difference there. You can see the month supply is going up, so they're getting more inventory. And then just anecdotally, I've seen a lot of instances where new home builders are definitely offering a lot of concessions and price reductions and seller credit and things like that, builder credit to entice buyers. So they're for whatever reason trying to get those those homes off their books, and they're dealing with the same headwinds that the rest of us in the industry are dealing with higher rates and people not wanting to move and economic anxiety and things like that. So overall, really not a good report here for new home builders, but it kind of jives with a lot of the other housing market. So next thing we got, so the average 30-year conventional ticked down a little bit. So we're down to 6.53%. Last week at 6.58%. That has to do with, just basically the fallout from, the Fed. It kind of ticked up a little bit with the Fed announcement, but then, kind of digested that. And overall, we're getting closer to that 6.5 number, which is great to see. Nice to get down below that 6% number, which we had done right before this war started. But at least some positive progress, because I think a couple weeks ago we were pushing 6.7 again. So down to 6.53% for the average 30-year conventional for good borrowers, putting over, let's say, 30% down. According to this lender survey that goes out to all of us. So good news on that front in the short term. Next thing we got. So important dates upcoming. We have the BLS jobs report coming up July 2nd. That's the big jobs report. That's, take it with a grain of salt, report. It's definitely hurt us more than helped us in the last few years, and they've done a lot of revision. So the one prior to this was pretty strong, and there was also some positive revisions. So it'll be interesting to see how that shakes out. And then a couple weeks after that, we get CPI, inflation. Probably get PCE again in that gap, and then the Fed meets again on July 29th, where right now the markets are basically pricing in that they won't do anything. They won't cut rates. They won't raise rates. But again, the world moves pretty quickly. So if things continue to improve, then at the very least, we might see some more dissent, some more push within the Fed, especially probably the chair to cut rates. And sometimes the market's just like that. Just the fact that there's more positive narrative going that way would help mortgage rates. So if anybody needs anything at all, please don't hesitate to reach out. Otherwise, I hope you guys have a great rest of your week. Thanks a lot, guys.